The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Looks like we have a pretty healthy crowd with us here today, so thank you for spending a portion of your Tuesday with us. Today, we're going to be talking about the key business and individual tax provisions of the newly passed Consolidated Appropriations Act of 2021, which, by my count, is the seventh piece of legislation passed in response to COVID-19. So who is here with you today? Currently speaking to you is Timothy Torres. I am a tax manager at W&G, and I will be moderating today's session. I'm pleased to introduce my colleagues and today's speakers. We have Len Nitty, shareholder and real estate practice leader, accompanied by Stephanie Holston, tax manager. So before we jump into the material, a few housekeeping items. We obviously do our best to present the most up-to-date information. However, should there be any future updates, please always remember to visit our website, as we are always publishing timely and relevant info. And if you're here today, I'm sure most of you have specific questions, and as they relate to your personal situation, I suggest using the GoToWebinar dashboard to ask any questions, and we will do our best to answer them at the end of the webinar. And please note, for those who want to reference this webinar at a future date, we will be uploading it to our website at wgcpas.com. So what do we hope to cover in the next hour? Len Nitty, he will be kicking it off with the business tax provisions and tax extenders. Stephanie will jump in to speak about one of the more important provisions, which is the employee retention credit. I'm going to pop in to give a quick overview of the most recent round of stimulus payments, and Len is going to take us to the finish line with the individual tax provisions and extenders. So without any further background, I ask Len to please jump in and start us off with the business portion.
Thanks, Tim. I appreciate it, and welcome everyone to our webinar today. Hopefully it's an informative one for you. I'll just start by saying that this doesn't encompass every single provision that was enacted by as part of the Consolidated Appropriations Bill, but we've identified a number of key ones that we wanted to focus on for the day. So the first one is the tax treatment regarding the Paycheck Protection Program loan expenses. And this is one where there was a lot of controversy over the course of the last year with regards to this one, where when Congress passed this law, they put into the bill that any income recognized as a result of the cancellation of the debt as it's forgiven was not going to be treated as taxable income. And while they didn't say it, it seemed clear that their intention was that, you know, you were not going to have any negative repercussions of receiving this income, and would be able to deduct the expenses as normal to give incentive to these businesses or support to these businesses during the current pandemic. The IRS then interpreted the language in the law to mean that because this was going to be treated as tax-exempt income, they determined that the expenses were connected to tax-exempt income. So those expenses paid with the proceeds of the loan, payroll, rent, and some other things would be non-deductible. So, you know, you basically were getting a forgivable loan, and it was going to be, you were going to be taxed on it, whether it was from recognizing it as cancellation of debt income or through a reduction in tax deductions. So to provide further clarity on this, when this new bill was passed, the Congress put in that to make it clear that the expenses paid for with PPP loan proceeds are fully deductible, in addition to having the tax-exempt status for the cancellation of debt income. They also further stated that there would be no reduction of tax attributes. The IRS will not be able to reduce losses, credits, fixed asset basis, or any other tax attributes that they may look to reduce when you have tax-exempt cancellation of debt income. There would be no denial of basis increases, so that taxpayers would be entitled to these deductions regardless of their tax basis. And this would apply to both initial and second draw PPP loans. Right after this legislation was passed, the IRS issued Revenue Ruling 2021-2 to make all earlier PPP guidance they issued obsolete. Also important to note is that the EIDL grants, these were up to $10,000 per company when you applied for an EIDL loan. These are also going to be now treated as tax-exempt income under this new act. Further, they applied not only this to individual taxpayers, but they also applied it to the owners of pass-through entities. So it's going to apply to S corporations and partnerships, confirms loan forgiveness as receiving tax-exempt treatment, and also allows for basis increases for the owners equal to the amount of the loan forgiveness so that they can deduct those expenses and not have any gating issues there. And again, this will apply to both initial draw and second draw PPP loans. Another item that comes up with the PPP expenses is, what are the states going to do? And are the states going to follow and fall in line with the federal government? New York has come out and given guidance that they are going to comply with the federal rules. It will be tax exempt and the expenses will be deductible. New Jersey is currently in the process of passing legislation. It'll probably happen, if not this week, next week, where they're going to fall in line as well, and any income would be tax exempt following the federal treatment, and the expenses would continue to be deductible as well for New Jersey tax purposes. So good news on the state front here as well, win-win all around for these struggling businesses. Another nice one that they put in is to help out the restaurant industry, and certainly hospitality types of businesses have been as hard hit as any during this pandemic. And this is to target and hopefully draw more business towards restaurants, where historically, if you take somebody out for a business meal, you're only entitled to deduct 50% of the deduction for those meals. So this act temporarily suspends the 50% limitation and would allow for a full deduction of meals and drink expenses, meals and beverage expenses for meals provided by a restaurant. And not only is it for meals eaten at a restaurant, it also includes takeout and delivery from a restaurant. So to the extent that you're buying meals from a restaurant for business purposes, you're going to be entitled to a full deduction, and that's really to hopefully help stimulate some additional business for the restaurant industry to help them recover from this pandemic. As I said, they've been as hard hit as any business throughout this. Another change that the Act gave us is in terms of the alternate depreciation system life for residential real property. And where this really comes into play is with the interest expense limitation, the 163J limitation, where real property trades or business were entitled to make an election not to be subject to the interest limitation. The trade-off for this was that they had to go from regular tax depreciation to the alternative depreciation system, and also would not be able to deduct any bonus depreciation on their real property. So this, a lot of people felt, unfairly hurt residential real property owners prior to 2018. So if you had a property placed in service 2018 or later, they were going to give you an ADS life of 30 years. For properties placed in service prior to 2018, if you made this election, your building was going to shift to have a 40-year recovery period, or 40-year life, putting them in the same position as owners of commercial real estate. So a lot of building owners felt that this was unfairly penalizing them for owning residential real property rather than commercial. And now with the CAA, we have a consolidation of the rules, and if you make this election, all residential real property will be subject to a 30-year life. So that raises the opportunity for those taxpayers that have made this election already and wish to correct this. They can do an accounting method change with their 2020 return to adjusted depreciable life and catch up on any depreciation that they would have been entitled to in 2018 or 2019 when they may have made this election. Also, another change to note is health and dependent care flexible spending arrangements. Plans may now allow for the carryover of unused benefits to from 2020 to 2021 and 2022. I guess a lot of taxpayers weren't able to fully use all of their benefits, and usually it's a use it or lose it type of situation, especially for those where daycare may have been shut down and they weren't able to put their kids into daycare, or one parent may have been out of work, so they were able to be home with the children. But you may adjust your plan to now allow for the carryovers of the unused benefits to help the employees, and they could carry them from 20 to 21 or 21 to 22. Plans may also permit a 12-month grace period for unused benefits or contributions for plan years ending in 2020 or 2021. Plans may increase the maximum age for eligible dependents to 13 for 2020 plan year for dependent care benefits. Typically, this is up to eligible dependents up to age 12. So they're giving you an additional year. This is to try to help compensate for the schools that may have been shut down, or you couldn't put the students in school. So you had to, hire somebody to help watch them while the parents had to work. But this is another potential benefit. And plans may allow for a change in election amounts for years ending in 2021. So even though typically you would make an election on the front end and have to, be stuck with that election unless you have a significant change in facts and circumstances, the plans may now allow for a change in the election amounts for the years, as I said, ending in 2021. This would require some action for a business to make to their plan to allow for this, but this is designed to be good for the taxpayers and to not have them lose their money for unused benefits where they may have been put into a bind or predicament based on what's been happening with COVID-19 and the pandemic. That brings us to a few business tax extenders that I wanted to touch upon. First one is a deduction for energy efficient commercial buildings. This is one that's been subject to expiration for quite a few years now, and they continue to renew it and extend it. The CAA has now made this a permanent extension of the deduction, so it will continue to be going forward. And one thing I always like to bring up when we're talking about permanent or temporary extensions is even permanent extensions are just temporary. They're there until somebody decides to change the tax law or Congress votes to change the tax law. So everything is always subject to change, even if Congress makes it permanent. But just know that this is now in place permanently, and not only that, it will be indexed for inflation beginning in 2021. And what this is where you're making certain qualifying energy efficient improvements, you're entitled to up to $1.80 per square foot immediate deduction for the cost of the real property, where you would normally have to depreciate this for commercial buildings over 39 years. You could get an immediate write-off, and it's effectively 60 cents per system. There's 60% for energy efficient lighting system, one for the HVAC system, and one for the building envelope. Also extended is the work opportunity credit. This is a credit for hiring targeted employees from one of 10 target groups, such as endangered youth or veterans, different groups that they want to give you incentive to hire. Credit is based on qualifying first-year wages paid to these employees, and the credit has now been extended through 2025. So another one that's been extended is the credit for renewable energy production. That is the credit for electricity produced by certain qualifying facilities has been extended. Certain ones were still in place and not set to expire, such as solar. Solar is scheduled to have the credit reduced at some point going forward, but the renewable resources impacted here are going to be closed and open loop biomass facilities, geothermal energy, landfill gas and trash, hydropower and marine hydrokinetic systems, and also wind. The credit was set to expire for these facilities where construction had not begun prior to January 1st, 2021. It's now extended it for a year to facilities where construction began prior to 1/1/22. And this one will be up for extension again next year, so we'll have to see if they continue to extend this one. New market tax credits is one designed to try to promote capital investments in distressed communities. And it applies to capital invested into a qualifying community development entity. The credit equals 39% of the capital invested. And credit allocations are extended through 2025, where they were originally set to expire. And effectively, if you're a community development entity, you can request to be allocated credits that you can then use to attract investors and give them this 39% credit for their capital investment to give them an immediate return on their money. The carryover of unused credits is extended for 5 years through 2030. So three other quick tax extenders before we turn it over to Stephanie. First one is a credit for paid and family medical leave. If you're providing paid family and medical leave, this is not your typical sick leave, but a more a longer process. Included in this is COVID-19 illness and things of that nature, or to care for somebody with COVID-19. You're entitled to a credit for certain employees. The deferral of employee FICA tax has been extended, where originally it was set to be paid back by the employee early in 2021. This has now been extended to later in the year. And the provisions of the Family First Coronavirus Act provisions, also for paid leave required to be paid to employees for COVID-19 illnesses. This has been extended into 2021. One important change being that it's no longer mandatory, but it's voluntary to continue to comply with this. So with that said, I'm going to turn it over to Stephanie for the employee retention credit.
Thanks, Len. Thank you, everybody, for joining us today. There's a lot of conversations happening about the employee retention credit right now, especially for a credit that we've had, for a bit. The ERC was originally created as part of the CARES Act relief that came out last March of 2020. And at the time, there wasn't a whole lot of conversation or too much excitement about the credit, because there was a restriction where if you received any PPP loan, you were not eligible to claim the employee retention credit. And that extended to affiliated companies as well. If you had a group of affiliated companies with a more than 50% common ownership, if any one of those companies within that group claimed a PPP loan, then none of the companies were eligible to claim the employee retention credit. So, when looking at the two options, a forgivable PPP loan ended up being a much better answer for a lot of businesses. So they went that route, and the employee retention credit kind of fell by the wayside. So now we're talking about the employee retention credit again, because what the CAA did was it made two major changes. First, it removed that restriction where PPP loan recipients couldn't claim the ERC. So if you got a PPP loan, you can claim the ERC now, and you can do so retroactively. You can claim it all the way back to its original enactment date of March of 2020. And the other thing that the CAA did was it extended the employee retention credit through June 30th of 2021, and it modifies the credit calculation for 2021 and makes it a much more valuable credit. So as we go through the presentation, we are going to go through both rules, the 2020 calculation and the 2021 calculation. So just be aware that it's two separate calculations. The CAA didn't actually change anything about the 2020 employee retention credit other than the fact that if you got a PPP loan, you can go back and claim it. The 2021 rules are different. So just a quick overview what the credit is. It's a refundable payroll tax credit. So it's a payroll tax credit, meaning that it's a credit against your Social Security and Medicare taxes. You would claim it on a quarterly payroll tax filing on your Form 941, and it is refundable, meaning that even if the credit is higher than your tax liability, you would get a refund for the difference. So if your payroll taxes only are $40,000 and you're calculating a $50,000 credit, you would actually get a $10,000 check back. So as the name would imply, the employee retention credit was created to encourage businesses to retain their employees and keep them on payroll during the pandemic. And it's available to eligible employers whose businesses were severely impacted by COVID-19. So who is eligible to claim the ERC? Again, this is under the CARES Act, which is going to govern the calculation for 2020. If you're eligible for 2021, that's a different credit and different calculation that we'll get into later. So this is just governing the credit for 2020. So first requirement, you have to have been operating a trade or business during 2020. And you have to meet either one of these two requirements. The first being that your business was fully or partially suspended by a governmental order limiting commerce, travel, or group meetings due to COVID-19. Or the second way you can qualify is if you had a substantial decrease in your gross receipts. So if your gross receipts in any one quarter were less than 50% of gross receipts for the same quarter in 2019, you're going to continue to qualify until your gross receipts reach 80% of where they were in 2019. And we'll go through an example of the gross receipts calculation because that is a little bit confusing. But first, I just want to go back to the governmental order requirement for a bit. So within that governmental order requirement, there's a few things that you have to meet just within that one sentence. So first, it has to be a governmental order. So, a suggestion or a statement by the governor encouraging people to socially distance and stay home where they can is not a governmental order. Also, if you decide to close your business, just to keep your employees safe, because it was voluntary, again, that wouldn't meet this requirement either if you're doing it, just on a voluntary basis. Second, the order has to limit commerce or travel. So let's say you are an essential business where there is a governmental order that limits commerce, but it doesn't apply to you. Say for a grocery store, that wouldn't be part of any kind of restriction because it's an essential business. That grocery store would not qualify under this first requirement. And the third is that it has to be due to COVID-19. So let's say, for example, you were forced to close due to, let's say, a health code violation. It is a governmental order, but because it's not due to COVID-19, you're not going to qualify under this requirement either. So a full suspension is pretty clear cut. So here in New Jersey, we had, for a time, all non-essential businesses had to close. So all non-essential retail, things like salons and any kind of non-essential retail was forced to close for a period. That's a full suspension. It's pretty easy to know when your business has been fully suspended. A partial suspension can be a little bit of a gray area, especially when the IRS has said that that partial suspension has to have a more than nominal effect on your business. So the IRS has a number of frequently asked questions on their website. That's a great resource that goes through a few examples of what a governmental order is, as well as a number of things on the employee retention credit. But they use the example of a restaurant a lot. So a restaurant, let's say, that is fully restricted for any kind of on-premises dining and is restricted to only takeout and delivery, clearly has a partial suspension of their business. Then it uses the second example of a restaurant that can do takeout and delivery, but now it can do outdoor dining. The outdoor dining is, much smaller, much less capacity to it. So that restaurant has a partial suspension still as well. And then it uses a third example of a restaurant that can now open for takeout, delivery, outdoor dining, and indoor dining. But the indoor dining, the tables have to be spaced out. There has to be social distance maintained. They're operating at a reduced capacity, under a governmental order that says, let's say, it can only be 50% of capacity, your normal capacity inside. The IRS says that this would qualify as well, but the example is very careful to say that the suspension has a more than nominal effect on their business. And with a lot of these requirements, the IRS doesn't tell you or define what a more than nominal effect is. So just keep in mind that if you're under a partial suspension and looking to qualify under that rule, it's going to be very facts and circumstances specific to your exact situation. And just keep in mind as well that if you qualify under number 1, only the wages that are paid during the period of the shutdown, during the suspension, are going to be eligible for the credit. So I wouldn't just say, okay, I qualify under number 1 because I'm fully or partially suspended, and not look at the gross receipts test, because if you qualify under the gross receipts test, all the wages that you pay during the entire quarter are going to qualify, as opposed to just the period of the shutdown. So let's go through a quick example of the gross receipts calculation. Now, gross receipts are going to include all of your income, from sales, from services, as well as any kind of investment income, interest, dividends, royalties, pretty much any kind of income that you're collecting. So just to make the math very simple, we'll assume that your gross receipts in 2019 are $100,000 per quarter. And let's assume that for the first quarter of 2020, your gross receipts are $45,000. So they're 45% of where they were in 2019. So because your gross receipts are less than 50% of where they were in 2019, you're going to qualify for the employee retention credit. And you're going to continue to qualify until the end of the quarter, where your gross receipts reach more than 80% of where they were in 2019. So in this example, in quarter 2, we're at 70% of where we were in 2019. So we continue to qualify through quarter 2. And in quarter 3, we reach 85%. So we're above now the 80% rule. So we continue to qualify until the end of the third quarter. So in this example, we would qualify for quarter 1, quarter 2, and quarter 3. So just a quick note that if you do qualify and are ever below 50% in 2020, you automatically qualify for at least 2 quarters because you qualify until the end of the quarter when you reach 80% again. So if we change the facts here, in quarter 2 was, let's say, 90% of where they were in 2019, you would still qualify in quarter 1 and quarter 2. So once you qualify for at least 6 months here. Okay, so we'll get into what the qualifying wages are and how exactly the credit is calculated. But again, I just want to stress that this is under the CARES Act and governs the 2020 calculation. So wages have to be paid between March 13th and December 31st of 2020. And the credit is going to be equal to 50% of the qualified wages paid to an employee plus the cost to provide health benefits to that employee. And the credit's going to be subject to a cap. It works out to $5,000 per employee. This is 50% of the first $10,000 in wages paid per employee. So what wages that you pay that will qualify for the credit is going to depend on how many employees you have. So if you have more than 100 full-time employees, then only the wages that you pay to someone to not work, to not perform services, are going to qualify for the credit. And if you have less than 100 full-time employees, then all wages that you pay will qualify, whether the employee is working or not working. So let's go back to the restaurant example because I feel like those are easy to relate to. So let's assume we're talking about a restaurant that has more than 100 full-time employees, and the kitchen staff is still working because they're able to be open for just for takeout and delivery orders. So the wages that you pay to the kitchen staff are not going to qualify for the credit because it's over 100 full-time employees and those employees are still working. If, let's say, you were still paying the hostess or the wait staff who were not working, then those wages could qualify for the credit, but not to the kitchen staff. But if we had a restaurant with less than 100 full-time employees, then all wages paid to everyone, working or not working, would qualify for the credit. And your number of full-time employees is going to be based on your 2019 monthly average. So you just have to figure out how many full-time employees you had each month during 2019 and average that together. And the definition of a full-time employee is going to be one that works less than 30 hours a week, or I'm sorry, full-time employee work more than 30 hours a week or more than 130 hours in a month. And just a quick note again, if you're familiar with the PPP loan process, there was talk about full-time equivalents. This is not the same concept. This is just straight full-time employees where you don't count your part-time employees at all. Okay, so moving on to the aggregation rules, this is a very important topic because the aggregation rules are going to determine a lot of your eligibility for the credit. So any group of entities that are treated as a single employer are going to be considered one employer for purposes of the employee retention credit. So the code sections referenced here refer to corporations that are commonly controlled, say a parent and a subsidiary relationship, or a corporation where the same group of people owns multiple corporations. Same thing for partnerships or other types of entities. If one person or a group of people own more than 50% of a group of businesses, and those businesses are looked at as one. And they're going to be looked at together for a few of the tests for the ERC. So number one, for the gross receipts test, when you're trying to determine if you've had a 50% drop in gross receipts, you have to look at the whole group together. So that could be detrimental if you have one business that was really hurting and other businesses that were doing better. It's possible you might not meet that 50% drop if you have a few businesses that are kind of propping up the other, the business was affected. Additionally, the number of full-time employees, you have to look at the entire aggregated group. So it's much easier to meet that 100 employee full-time employee limit when looking at the aggregated group together. And finally, the last point could be a positive. It could be helpful when determining your eligibility. If you have a group of businesses and only one of them is subject to a governmental ordered shutdown, then the entire group is actually going to qualify, even if only one of the businesses is shut down. So that could be a positive where you could be bringing in businesses that are going to qualify that might not otherwise have qualified if not for this aggregated group rule. Okay, so now we're moving on to what the ERC calculation is for 2021 under the Consolidated Appropriations Act. So again, the CAA extended this credit. It was originally scheduled to expire at the end of December of 2020. The CAA has extended it for the first 2 quarters of 2021. So now wages paid through June 30th could potentially qualify for this credit. So we still have the same 2 tests, and you have to meet one of the 2. So you still have that same fully or partially suspended by government order. Nothing's changed about that requirement for 2021. And we still have a gross receipts test, but it's actually much easier to meet in 2021 than it was for 2020. Instead of having a 50% drop in gross receipts, you only have to have a 20% drop. So you'd compare your 2021 gross receipts to 2019 gross receipts. And if your gross receipts are less than 80% of where they were in 2019, then you're going to qualify for the credit. Now, there is an option to elect to use the immediately preceding quarter when you test the gross receipts. So let's say, for example, we're trying to determine, do we qualify for this first quarter of 2021? So instead of looking at 2021, we could look at the immediately preceding quarter. So we would look at Q4 of 2020 compared to Q4 of 2019. And if we meet that 80% rule, then we'll qualify for the first quarter of 2021. So it does help a bit if you're trying to plan ahead or determine whether you're going to qualify right now, whether you want to apply for an advance, which we'll get into. It's helpful to know that just by looking at last quarter that you qualify now, you don't have to wait and see, over the next 2 months what the quarter shakes out ends up looking like. So some more rule changes, some more calculation changes. Instead of the credit being a 50% credit of qualified wages, that has gone up to 70%. So 70% of qualified wages paid to the employee plus the cost to provide health benefits are going to qualify for the credit. And instead of having a $10,000 annual wage cap, we now have a $10,000 wage cap per quarter. So 70% of the first $10,000 in wages means that you could have a $7,000 per employee credit, and that's for each quarter of 2021. So for an annual basis, you could be looking at a possible $14,000 credit per employee. So it's a much more lucrative credit now than it was for 2020. And additionally, because there's no restriction on claiming the credit for 2021 if you already reached the maximum in 2020. So even if you, for the same employee, received a $5,000 credit in 2020, you can still get the $14,000 for that same employee in 2021. So across 2 years, you could be looking at a maximum of $19,000 per employee. So it's a very, very beneficial credit. So moving on to the full-time employee test. The number of full-time employees increases to 500 instead of 100 employees. So if you have a business that has less than 500 employees, all of the wages are going to qualify for the credit, no matter if employees are working or not working. If you have a business with more than 500 employees, then we're back to the same rule where only the wages that you pay someone to stay home to not work are going to qualify for the credit. But it's much easier to meet the 500 employee test than it is for 100. And keep in mind, again, that the aggregation rules still apply here. So you do have to consider the 500 employee threshold on an aggregated basis. That rule has not gone away. Okay. So there is an advance available for the employer retention credit referred to in the law. This is something that existed last year as well for the employer retention credit and for some of the FFCRA credits as well, where you could reduce your payroll tax deposits in order to get that cash available to your business right away. But if you anticipated the credit was going to be even more than what you would have deposited, you could apply for an advance of the credit. So the CAA does say that if you're a business with less than 500 full-time employees, you can receive an advance of the credit that's up to 70% of your average quarterly wages paid in 2019. It doesn't specifically give a mechanism of how to get this credit, but what was created last year was that there was a Form 7200 that you would file with the IRS in order to receive a cash advance. As of now, that 7200 has not been updated. It still refers to the fact that, that these credits expired as of the end of 2020 and refers to the fact that, the form is due no later than February 1st. I have seen that the IRS, I believe, is anticipated to update this form by the end of the month. So we're only a few days away from that. So hopefully we see an update of this form that'll provide some clarity on how to get this advance. So for now, just know that this is out there, and hopefully we see some more on this soon. But if you file for the advance and receive a cash advance, just know that you have to reconcile that when you file your 941. If you receive more than you were entitled to, you might have to pay it back. And if you end up, it ends up being that your credit is more than you were anticipating, then you would receive a refund. So that would be done when you file your 941. You would just reconcile the cash advance to what the credit actually was. So just a few things on what the impact of the ERC is on some other income tax related items and other credits. Nothing really new here. There's a pretty common, no double dipping sort of rule that the IRS has. So you can't take a wage deduction and also take a credit. So if you are claiming an employer retention credit, then you have to reduce the amount that you're deducting for wages by the amount of the credit. Again, nothing new here. There are similar rules exist for other credits like the research tax credit and other credits. Also, you can't use the same wages to claim both the ERC and any of the sick leave or child care leave that was created under the FFCRA. You can claim both credits, but just not on the same amount, same exact wages. And you can't use the same wages to claim the ERC and other credits, such as the research tax credit, work opportunity credits, any of these other credits that are based on wages. So the big impact here is that you can't use the same wages for PPP loan forgiveness and the ERC. So the law seems to give priority to the ERC here, where you would first use your wages to claim the ERC, and then what was left over would be available for PPP forgiveness. But we definitely are anticipating and needing some additional guidance from the IRS for a number of these areas, especially if, let's say you've already applied for PPP forgiveness. What do you do then? Since you probably don't have the opportunity to go back and amend any kind of forgiveness application. And what happens if you've already received the forgiveness? It's been approved by the bank. So let's assume that we had a PPP loan for $500,000, and we had $600,000 of wages that we spent. So technically, we overspent our PPP loan. We would have achieved full forgiveness. So do we get to just use that extra $100,000 and use it towards the ERC, even though we reported it on a PPP forgiveness application? It would seem fair and it would seem logical that we could use that for the ERC, but we don't have that guidance from the IRS yet. And let's say there were other expenses that may or may not have been reported on the PPP loan forgiveness application, but otherwise could have been used by that loan, like rent, utilities, other things. Could we say that we could have used those expenses, therefore we have more wages to claim the ERC on? Again, we don't know. So hopefully the IRS comes out with some more guidance there. The frequently asked questions that are on the IRS website that I referred to before, it does have a big warning sticker on the front when you get to that website that says that the ERC has been amended and updated by the CAA, and these frequently asked questions do not reflect that. So hopefully that gets updated soon, but the IRS is clearly acknowledging that they have some questions that they need to answer for us. So in the meantime, we would recommend to delay any application for PPP forgiveness if you can, so that you can take a look and make sure that you're maximizing the benefits under both programs, because this is a really potentially big opportunity for a credit, and if you can make both programs work, you certainly should. And just to note, the last action item here is keep an eye out for this Form 7200. We'll certainly release some updates on our website when anything comes out. But we would anticipate that would be the mechanism for claiming a cash advance if you do qualify for the 2021 credit. And with that, I think I'll turn it back over to Tim to speak on the new round of stimulus payments.
Thank you, Steph. While you were speaking, I didn't see any questions come through on your portion, so either you did a fantastic job or we have some shy viewers at the point. If you do have any questions, definitely want to have them answered at the end of the webinar, so please don't be shy. Okay, stimulus payments. I'm going to focus this discussion on what has happened and not what could happen. We could be here all day as to the debate in Congress on the moment for the potential third round. So, first round, this was governed by the CARES Act, and it was $1,200 per taxpayer, $500 per child. The second round, which is currently now being distributed, was $600 per taxpayer and a $600 per child cap. Now, for the recipients of this stimulus payment, there were income limitations that were unique to each round. Instead of listing them, I'll just go over them briefly, but again, this is widely published information, so feel free to look at an FAQ. But if you didn't receive any stimulus for the first round, that might be because of the following income thresholds. For single taxpayers, it was $99,000, and you were uneligible. For taxpayers filing head of household, that was $136,500, and for married couples filing jointly, that was $198,000. Now, for the second round, the income threshold actually decreased, which was in line with the decrease of the actual stimulus payment. So those income thresholds dropped from $99,000 to $87,000 for single taxpayers. For head of household, it dropped from $136,000 to $124,500. And for married couples filing jointly, it also dropped from $198,000 to $174,000. And just a quick note, if you're doing any of your own research on the stimulus payments, you'll often see that there's an interchangeable term used. We often call it stimulus payments. The IRS is referring to these as the economic impact payments. So just keep that in mind. They're one and the same thing. As far as timing goes for the second round, those direct deposit payments started on December 29th. Paper checks were issued or beginning to be issued on December 30th. Move on. So the question, the next natural question would be, okay, well, my stimulus payment is either missing or it's incorrect. And there are a few ways that you can remedy that going forward into 2020. And the IRS is actually urging all taxpayers to make it their burden to determine whether or not they were eligible, such as recent college graduates is something that they're focusing on. If you believe that you were excluded incorrectly from receiving a stimulus payment, be on the lookout on the 2020 Form 1040 when you file your 2020 taxes. There will actually be a line there, not yet known, but there will be a line there where you could reconcile to the correct amount that you believe you were due. A form that the IRS is providing to help you as a taxpayer reconcile those payments is Notice 1444, and those should have been issued to any taxpayer that received the payment. So again, if you believe you were shorted on any stimulus payment due to you, this is your opportunity to make up for the difference. Then the next question would be, okay, I received the stimulus, is it going to be taxable? And the answer is no, not at the federal level. And the next natural question would be, okay, at the state level, is there a potential? And some states have recognized that a lot of taxpayers are going to have this question. And the few of the states we have listed here, more importantly, New Jersey, PA, NY, the tri-state area, they have provided guidance stating that it will not be taxable. And just a quick note, the stimulus payment isn't going to impact a taxpayer's eligibility for other federal programs or state-assisted benefit programs such as any welfare or Social Security or Medicaid. And with that, I'm going to turn it back over to Len.
Thanks, Tim. Another one of the individual tax provisions as part of this bill was the consolidation of tuition benefits. So we've historically had three different education benefits. One, the American Opportunity Tax Credit. A second, the Lifetime Learning Tax Credit. And then third, there was a qualified tuition deduction that was also available. So this act eliminates the qualified tuition deduction, and it consolidates the phase-out amounts or the phase-out thresholds for both the American Opportunity Tax Credit, which is targeted towards your first 4 years of college, and the Lifetime Learning Credit, which can be used in any year of college for tax years beginning after 2020. And now we're going to have the joint phase-out of both programs, which is the historic one for the American Opportunity Tax Credit for married filing joint individuals between $160,000 and $180,000. Single head of household between $80,000 will start to be phased out and fully phased out of the credit at $90,000. The child tax credit and the earned income credit, there is a refundable component to both of these credits where if you qualify and even if you don't have a tax liability, you can have it refunded based on your earned income level for the year. And to make sure that taxpayers aren't harmed by reduction in their earned income due to either being laid off or working reduced hours or having their self-employment income significantly impacted by the pandemic, taxpayers are going to be able to elect to utilize their 2019 earned income for purposes of calculating the refundable portions of both of these credits. Few individual tax extenders to touch. Charitable contribution. The CARES Act had eliminated the contribution limit for qualifying contributions, which are going to be cash contributions to 50% charities. There's not going to be any limit on how much you can make for 2020 or 2021. The Tax Cuts and Jobs Act had imposed a 50% of AGI limit on your deduction for charities to qualifying charities, and for 2020 and 21, and as I said, this has been removed. There was also a $300 above the line deduction that was put in place by the CARES Act for 2020. Charities are hurting right now, just like any businesses, because of the reduced income of a lot of their supporters. So this is designed to help stimulate contributions by giving those that don't itemize a $300 deduction, and the CAA has extended what was put into place by the CARES Act through 2021. So this will apply for both 2020 and 21. The CAA did increase the penalty for overstating charitable deductions for the non-itemizers, and it's increased to a 50% of the tax underpayment. So even though they're giving you this $300 deduction, they don't want everyone just to put it on their tax return just because they're entitled to it. They want to make sure that they actually incurred the charitable deduction or made the charitable contributions to qualify for it. For medical expenses, they've permanently extended the 7.5% floor for medical expense itemized deductions, where you don't get to deduct any unreimbursed medical expenses until you exceed 7.5% of your AGI. This was scheduled to go back to 10%, but it's been permanently extended. This is effective for tax years beginning after 12/31/20. The exclusion of cancellation of qualified principal residence indebtedness has been extended through 2025. This is where if you have cancellation of debt on your principal residence, you can exclude it. Note that it reduces the maximum exclusion down to 750,000. It was 2 million. Now it's 750, and if you're married filing separate, each spouse would be entitled to 375. Other extender provisions, non-business energy credit. This is for energy efficient improvements to your home. The deduction for mortgage insurance premiums has been extended to 2021. This one is one that gets phased out, where mortgage interest premiums can be treated as mortgage interest for purposes of your itemized deductions. So this was moved forward for one more year. And an exclusion from income for employer payments of student loans, up to $5,200 each year. So if you as an employee are receiving a reimbursement or a payment towards your student loans from your employer, you could exclude that from income up to $5,200 per year. So Tim, with that, I think that ends our content for the day. So if we have any questions, looks like we have a moment or two to answer a few. Otherwise, we can wrap up.
Yep, we do have a good question, and it is pointed to you, Stephanie, regarding the ERC, and I think it's a good question because it beckons to your warning as to the integration between the PPP forgiveness and the credit itself. So the question is, if an employee receives more than $100,000 a year and the PPP funds were only applied to the first $100,000, can you receive the ERC on any excess wages above and over the $100K?
Yeah, that's a great question. And that's one of the things that we want the IRS to comment on, because, you know, it's certainly not addressed in the law. And again, it seems like one of those things that seems logical and seems fair, but we definitely need the IRS to issue some guidance there.
So TBD.
TBD.
Yes, unfortunately, but we appreciate the question. I think that was it for the ERC. A few of the participants today did ask about a PDF of the PowerPoint. I will circle back with you specifically on that question, but I know that the webinar will be saved to our website at wgcpas.com in the meantime. So with that, I think I'm going to wrap this up, and appreciate the panelists, and I appreciate all the participants for their time today.
Great, thank you, Tim. Thank you, everyone, for joining us today.
All right. Thanks, Tim. Thank you.
Yeah, of course. Thank you. Bye-bye.